How to make 1 crore with the 15 into 15 into 15 rule. So this is a concept that I came across recently, and I thought this will be helpful for everyone. So I'm making this video, and how to make 1 crore. So we all want to multiply our money. So we invest in various things like gold, real estate, or stocks and mutual funds, and so on. So here I'm going to show the plan for achieving this goal of 1 crore with this rule. So what is this 15 into 15 into 15? The first 15 here is 15,000 per month, and the second 15 is 15% annual return, and the third 15 is 15 years. So let me show you in the Excel how the calculation works out. So this is the year zero. So we start from year zero, and as mentioned, we are uh, going to invest 15,000 per month, which is 15,000 into 12 is 1,80,000. And for that, we are going to get 15% annual return, which is 27,000. So principal plus capital is 2,07,000 at the end of year zero. So year one, we are taking both the year zero's capital and return. And we are also introducing a new capital of 1,80,000. So that gives us a return of 31,050. So together now the cumulative value that we have is 4,18,050. So we are going to do this for 15 years continuously. And we are going to consistently make 15% annual return. And by the end of 15 years, we will be having 1 crore and 2,48,846. So if you see here, the total amount that we have invested here over the period of 15 years is 28 lakhs and 80,000. So if we are able to consistently get 15% annual return on this 28 lakh 80,000, we will be able to get this final value of 1,24,846. So that is how we are going to achieve this. But where to invest? Where to invest and how our money will be multiplying or compounding at this rate so that we will be finally getting this value. So generally speaking, one can invest their money anywhere, and if they can get this consistent returns by investing in whatever they feel like, they can do so. But in this situation, what to do? Like, here we are going to look at history. So, if you look at history, the Indian stock markets have been able to give us the consistent return that we are talking about here in this Excel. So, let's have a closer look at the Indian stock market here. So, when I say Indian stock market, does that mean that you should invest about 1,80,000 of your money in stocks directly, individual stocks? No, that's not what I mean. What I mean is uh, you have to get this market exposure without investing in direct stocks. So how to do that? So for this purpose, we have something called as index. So here in this example, we are taking Nifty 50 index. So what is this Nifty 50? So Nifty 50 index is nothing but a collection of 50 Indian companies, 50 top Indian companies, and based on their performance, we will be getting this returns. And if you look at this chart, over the years, we have been seeing consistent returns. So let us look at the last 10 years data. Like let's start from 2010. So in 2010, the return has been 17.25 percentage, and 2011 there has been some big crash, so the return was negative minus 24.62 percentage. And in 2012, whatever loss was whatever negative returns was there in 2011, it all recovered, and we are now at 27.7 percentage. 2013 we have a small return of 6.76, and 2014 there was a massive return of 31.39. This is because Narendra Modi became the prime minister. So since he won the election, the markets were all on a high. So that's why we see these returns. So if you see consistently, we were able to get some return. So let's see in Excel what is the average return over the last 10 years. So average return over the last 10 years is 10.12 percentage. So this is much lower than our target of 15 percentage, but still this is to be expected in a volatile market like stock market, because because it is influenced by various market factors and other political events. So we got this return. And also we should note that this is only the return percentage of 10 years. So, but our time duration is 15 years. So there are chances that in the next few years, this value will add up to 15 percentage. So, okay, now this is the return for last 10 years, but let's go even backward and see the historical returns prior to 2010. So, yeah. Okay, so if you see here, this is data from 2000, year 2000. So if you see for 2000, the returns are negative, minus 14.65, and that is due to the dot-com crash, which happened in the US, and that certainly affected the world markets as well. And of course, in 2001 as well, 16.18, and so on. So but if you see in 2003, the return is 71.90 percentage. So whatever loss was made here, it was all recovered in this year. So like that consistently, if you see, even there is also a minus 51 somewhere here, which is 2008. As we all know, this is the housing bubble crash in United States. So that has also again recovered in the next year itself. So coming down to 2020, so we are at 14.17 percentage. We are up by 14.17 percentage in spite of the COVID crash. So this is how the stock markets work. I mean, it's not going to be a smooth ride. It's going to be a bumpy ride, but that's the nature of the markets, which is not in our control. So a long-term investor need not worry about the volatility which happens in the short term. So because in the longer duration, we are expecting a return of 15 percentage, which is very much possible. So let's have a look at the Nifty index chart itself for all time. So it started somewhere in 1996, and if you see, the momentum is continuously upward. That is, there are some crashes here and there, like in 2007, December 2007 and January 2008, it crashed and crashed by about 50 percentage, and then it recovered, and again it crashed in 2020 in March because of COVID. And again, see the recovery rate, it has recovered double from where it had fell. So that is the nature of the market. So this is how we are able to make money by consistently holding on to our funds. So also one must note that we are not going to invest here at this top and sell here and make a loss here. So we are at least going to hold it for like 10 years or more. So by doing that, even if it crashes here, so like 10 years down the line, we would have at least made a profit somewhere here. So that's how we have to look at the markets. And also one more topic which I wanted to talk about is about the index itself. So let's have a look at the Nifty 50 index. So as I said, the Nifty 50 is a collection of top 50 companies in the index. So how does this Nifty 50 give us such huge returns over a period of time? Is it some kind of magic? No, there is certainly not any kind of magic. But yeah, let's see about it. Like if you see the Nifty index, these are the underlying companies. So there is HDFC, ICICI, there is Airtel, there is Britannia, and so on. So these are the kind of companies which we come across in our life every day, and we use at least one product of these companies on our day-to-day life. For example, Britannia, like let's say, of course, the biscuits which they sell. Like 10 years ago, maybe we must have paid 10 rupees for a pack of biscuits, and today it will cost us 15 rupees. So there's a 50 percentage increase in their product. So we are paying that price. And obviously, when we are paying more price for their product of the same quantity, the valuation of the company is also going to rise over time because of inflation. So this is another concept which we have to talk about because it's a very important concept. So India is currently at 6.62 percentage inflation. That is last year's inflation percentage. And if you see over a period of time, we have only been on the uptrend of inflation. That is, we have only had increase in the percentage of inflation. Of course, there has been small dips here and there, like 4 percentage in minus 4.41 in 2014 and minus 1.62 in 2017 and so on. But that does not mean that inflation has reduced. We are certainly not going to become a deflationary economy. So, and that's the reason that we are able to make these gains over time, and we can achieve this goal of 1 crore within 15 years. So this is just the calculation for this amount of money, that is 1,80,000 per year, and the duration is 15 years. But the reality is our salaries or our income is not going to remain constant, which means that we can contribute more. And let's say this 15,000 can be like 18,000 or 20,000 per month. So by doing that, we are drastically reducing this duration of 15 years by say 13 years or 10 years, depending on the amount of money which we are committing every month for investment. So that way, we can cut short this duration much shorter, and we can achieve our goal much faster. So, does that mean that you have to invest all your money into stock market or something like that? No, that's not what I mean. This means that the stock market has the potential, and it is an opportunity to make so much money in a given duration. But diversification is very important because one must not put all the money in stock market also, and not all the money into real estate or gold also, because stock market is a volatile market, whereas real estate and gold, they have a different approach. Like the returns might not be as good as we expect in 10 or 15 years time. So it's very important to diversify your funds, but what matters more is the discipline and the consistency. So we have committed some amount per month, so that we have to do it month on month, and we also have to consistently do it over a period of time to see good returns in the stock markets or the mutual funds. So, thank you so much for watching till the end. And I would also like to thank the viewers of the Tamil video of the same topic which I made prior to this one. So, I thought I'll also make one in English so that people who do not understand Tamil will also be benefited, because this is a topic which I feel that everybody must know, because this helped me a lot in my in the way that I look at things. So I hope this was helpful to you in some way or the other. Do let me know in the comments, and if you like this kind of content, please subscribe to my channel, because I will be making more videos like this in the future. Thank you so much.